All right, hello, my name is Steven Mendoza. I'm going to be doing problem number 4 of chapter 12. And basically, this problem just wants you to find the MPV, cash flows, and other performance metrics for a project, and it gives you some information. I have them categorized here. And I'm just going to make a model on Excel to showcase um, how you can get these calculations. So firstly, I'm just gonna give myself enough room for this. I go around 30. Outline. Just really quickly do this. And then, oh yeah, sorry, make this wide enough. It should be good. Mm, okay. Sorry. All right. So firstly, I'm just gonna put down some of this given information that we got. This will be really useful for our ratios later and calculations. So the first ones I'm going to do here, these yellow ones, these are, I have these as the initial investment year zero ones. So uh, cost of new land, new building. Yeah, just which our new land is 200,000. 200,000. And the new building and equipment is 350. And net working capital, or in this case, increase inventory. And then that's going to be 45,000. Really quickly, I'm just gonna Tacoma style. Give this just this is just here, so separate it easier, looks better. Um, yeah, now I'm gonna do the information that's given to solve some of the cash flows. So uh, first of all, the biggest one being oh, turkeys per year of 650 here, and then so we're going to be doing, because the revenues are going to be the same, as you see, the selling price is going to be the same for both projects, or maintaining what we have and taking on the new project. Our cash flows are actually going to be determined by the savings on the different difference in costs. So we do old, sorry, I keep forgetting, old cost per bird. Bird of, so it's going to be, the old cost was $8, but Um, you also have to take into account the shipping expense, so it's actually gonna be $9. The old price per bird, new price, oh, sorry, cost per bird. And this is essentially like cost of goods sold. And then yeah, that's gonna be the new $7 plus the $1.25 change. So that's gonna be 8.25. All right. And then yeah, so we're just gonna want to calculate our savings, total savings, net savings, whatever you want to call it. But this is essentially just the difference between these. because this is how much we save, right? The old cost was $9, new one's 8.25, so that's how much we save on that. It's 75 cents. Then multiply it by the amount of turkeys, obviously, and this is how much we're saving per year, basically. Sorry, I keep saying basically. Right. And then I'm just gonna cut this off here. Now I'm gonna be going down this way, which is also gonna go into terminal cash flow value and also our after-tax cash flows, which, yeah, the labor expense, additional labor is going to go up by 250. All right, that's good. And then, let's see, yeah, we're also going to do salvage value. Salvage value of um, the building equipment. Building equipment. And it does say that the land doesn't land doesn't appreciate, so salvage value is going to be 100,000, and then we're just going to really quickly do the life of this. This will be used for later, which is 5 years. All right. Now, lastly, two bits of information is going to be tax rate and WACC. Tax rate, sorry, rate, WACC, and tax rate is 25, I believe. Yeah, 25. We're going to do 20, 25, and then times 12. And then quickly, we're just going to format these percentage, 2%, and then, yeah, oops, should not, whatever, and then the rest of these, so that's pretty good. All right. All right, now that we have all our given information, now we're just going to go on to calculations. I'm just going to want to separate this so it looks a little better. Oh, whoops. Calculations. Very good. Now, things we're calculating, obviously first and foremost, are cash flows. So, uh, cash flow, oops, outlay, which is really just our year zero cash flow, and then we're gonna do after tax cash flows. Sorry, I keep forgetting on capitalizing these. Okay. And then yeah, that's gonna be so year 1, 2, 3, 4, 5. And then we're gonna do terminal uh, cash flow, which is really easy to get. All right. Yep. And then after that, I'm just gonna divide this. Well, honestly, I should. It's over here. Right. And then after that is our other thing. So payback period. Actually can't do discounted payback period just because I don't have the add-on, and I know you said we can't use add-on, so I'm not gonna do that. Uh, NPV, profitability index, internal rate of return, and modify internal rate of return. Okay. We don't need this space, so we're actually just gonna delete that. Yes, okay, good. Now, go ahead and start calculating. So, start off with the initial outlay, which is your year zero, which is really just um, your initial investment plus net working capital, which this is initial investment, net working capital is here. Really easy to get. And then just make sure that's negative because again, that's your initial investment, it's cash you're putting in, that's an outflow. Oh, real quickly, I do have a professional or professional casual, I guess, but have the yeah, you get what I mean. Sorry. Um, sorry. Yeah. Now our cash flows throughout the years, and if you've ever done um operating cash flows, it's basically just your revenues minus costs, and then you subtract out depreciations before you go into the tax rate, just so you could have that depreciation tax shield, and then you add back the depreciation. So I'm just going to quickly do that. We don't actually have revenues because the revenues are going to be the same, so we're just going to do the savings minus the costs. So this is the savings. So real quickly, savings minus the costs per year. This is on a annual basis or per period basis. And then you subtract the depreciation, which in this case land is not being depreciated. It's just the building equipment, but we're not going to depreciate all of this because it does have a salvage value. So subtract the salvage value, and then it did say we're doing a straight line method over 5 years. So we just divide by the life of the building equipment. It's good. Yep. All right. And then after that, we multiply by the tax rate, which we're not going to do the tax rate um, just straight into the tax rate because that would give us the how much we're being taxed. You do one minus tax rate, so that way you know that the, what you're getting left after you tax. And then you add back the depreciation, which in this case is just this. So right here, leave is just this, if I'm correct. No, sorry, it says, yep, add back depreciation. There we go. Now we have our per period operating cash flows. It's going to be year one. It's going to be the same for each year. So we're just going to do this. Well, besides year five here. But we're just going to add the terminal cash flow, which is really easy to get. You just do the amount of money you get back at the end of the project, which is uh, the sale of land plus the sale of the building equipment, which is a salvage value because it's been depreciated, and any networking capital that you get back. And that's terminal cash flow. And now year five to add at the very end. Right. And then now we're just gonna go ahead, do the rest of these calculations, which the payback period is how many these years going to take for initial investment to get paid back. So it's really just this divided by a period of cash flows. So it's going to take 3 years, right? So, well, 4 years to fully pay it off, but around 3 years to pay this back. NPV, present value of the project, so what the project is worth right now in a dollar value. And to do that, as you can see here, you just do the rate and the value. So the rate is our WACC, cost of weighted average cost of capital, and then the rest is just our operating cash flows for throughout the years, and then you add back the um, initial investment. So this will give you your NPV. I see it's positive, 287,000. That's good. That means if it's positive, that means you want to take on that investment. All right, PI profitability index. This is just calculated. There's no function on this. You just have to outright calculate this, which it is yeah, it's just gonna be earnings over cost, I believe. So it's this earnings MPV, yeah, MPV minus U over U again, but negative. All right, yep, profitability index is profitable. Yeah, that's just how you do that in Excel. And then these last two do have uh, functions in Excel that you could do. It's really simple. You just do, again, cash flows and the initial investment. That's it. Internal rate of return. It's just the rate of return for the project. That's it. And then this is also very simple. It's rate of return, but modified. It's the M in that. And it's essentially the same thing. Oops. This, except it's a little more realistic because it takes into account the weighted average cost of capital. And to do that, you just essentially what you did with the total rate of return, and then the next two values, you do the weighted average cost capital. Just that's how you do that in Excel. Now, this is all good. This is again, these are all estimated amounts. We're getting the future cash flows, so we're estimating, and these are the estimated profitability ratios, different types of ratios that we have. But not everything goes expected um, for the company. So sometimes things go good, sometimes things go bad. So as you see here, it is asking, yeah, the management is uncertain about several variables. So we're just going to tweak some of the variables being labor expense, salvage value, and salvage value of land, just to see differences in these indexes and ratios and also the cash flows. So to do that, you're just going to want to do a what if analysis in a scenario manager, and it'll show you the differences if you change or tweak a couple of variables. But first, before we do that, we're just going to define some of these variables, such as the labor expense, which is going to be labor expense is, sorry. Oh, sorry, I was naming this cell, my bad. So yeah, labor expense, which is going to be this one. Labor, sorry, labor. And then in here, you do have to do undercase. You can't have spaces or any other types of symbols. It's just how it works in Excel. Expense. And that's good for this. Now, salvage value of building, which is going to be right here. Define name. And then this is just going to make it easier for us to reference it in the scenario manager. Salvage value building equipment. Yep, looks good. And then lastly, salvage value of land, which because it's not actually being depreciated, there's not really salvage value. So the salvage value is really what we're selling it for, which is how much we're buying it for, the historical cost of it. So we're just gonna have this be set new land, name it to what it wants to be. Salvage. Whoops. Value. Value. I guess we do have whatever. Blend. Okay. Good. Now that we have all those things with names, it's gonna be easier for us to what's going on here. So here's the scenario manager. This is where you create scenarios, and then you go ahead when you click on them, you show them to see the differences in the different ratios and tax, or not tax, cash flows. So we're just gonna go ahead and add scenario, and then as he wants us to have these specific scenarios, do expected case first, just because we don't have to change anything. This is our expected case currently. All the as you see here. Then you have to make sure you have the changing cells, right? The cells, the variables you actually want to change, right? So the ones we did earlier, we're going to do it um, in order. So labor expense first, which is here, and then comma. We're going to do sales value building here, and then sales value land, or just how much we're going to sell the land for there. Then these are all the same. This is the expected case. These are all good. Then we go to add a new one, new scenario. Let's do best case scenario. And then it already has the same cells here, but this time we're going to change it to 200,000. So best case scenario, we're able to put the labor expense down to 200,000. And then best case scenario, salvage value is going to be 50,000. So we're going to be able to sell it for more. And then this is going to be 300,000. Sorry, is that one too many? Yeah, this one too many times. And then go ahead, add another one. Just do worst case. Then the cells are already there. Worst case, labor expense is going to be at 350. That's good. Worst case, sales value is going to be at 20,000. One less zero, yep. And then 40,000. All right. And see now we have the different scenarios. We can just go out and click on one. So this is our expected case. If you go ahead and click on it and then click show, as you can see, it changes all of the cash flows and different um, metrics we have here. And it basically just shows management different scenarios and how it would affect the different things you want to see. All right. That's pretty much it. Thank you.